Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show on a day that should probably be a national holiday. D, welcome. You want to do the disclaimer first?
Yep, good morning, everyone. And before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's
Excellent.
the disclaimer, and I'm going to share my screen.
You watched the game last night?
Yeah, I did. That's why I'm a little bit tired today. It went into
Well,
overtime. It was
most Americans are. Why? Yeah, I
yeah,
mean, my son is like, "Why don't we play? Why don't they play it on Saturdays, Dad?"
yeah,
You
yeah,
know, I mean,
yeah.
it's Saturday. It could start at 8 at night. It would be fine. But yeah, it's
Well, it didn't even start that late, right? It's maybe because of
yeah,
the
it's 6:30
overtime.
kickoff, but it's always like a four hour plus because they have long halftime show.
Yeah,
You know,
it's
this year
longer.
they're, you know, 9 or 10 times they were shooting Taylor Swift in the Sweet.
Okay.
It's a longer dynamic. But I
Yeah,
thought it was a good game. There's some mixed reviews of the game in the chat, but I liked it. It was
yeah,
somewhat fun.
yeah, it was an interesting game for sure. It was close all the way up to the end. Um, all right, so anyway, if you guys are joining us for the first time, by the way, welcome. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. And if you have a question, type it into the live chat on YouTube. Will's watching it and he'll read them back to me. We're going to take a couple minutes to give you a chance to put in questions. We'll start out looking at the pre-market report, see if we could get insights, what's going on in pre-market trading, and then we'll move on to those questions. All right, so the pre-market report over here. Up top, we have this calendar view, which does allow you to go back in time. You could drop down this calendar, pick a date if you wish to see what happened in a pre-market hours at an historical date. And on up here, we show the stats for the last week from a high level. This allows you to just eyeball if there are any type of trends or patterns or something that pops out. Today, we're on February 12th, and we see so far there are 487 stocks trading higher in the pre-market and 290 stocks trading lower. If we can look at the volume, we have 159 million shares trading on up volume, 50 million shares trading on down volume. And if we convert that volume to dollar value, we have $2.1 billion worth of stock trading higher versus $1.3 billion worth of stock trading lower. And this points to a bullish lean in the pre-market trading um, from a high level. So we could come down and see if we could look at it from a couple more perspectives, then we'll move on to the questions. Okay, so now we could come down here and we have a list of stock symbols that are trading in the pre-market along with the price change, volume, some alerts. Their list is split into the most active stocks, the biggest percentage gainers in the pre-market, and the biggest percentage decliners. Here we have 55 stocks that met our percentage gainers list, 31 on our decliners. This also points to a slightly more bullish lean in the pre-market trading from that perspective. Now, to make this list, we set certain thresholds for volume, liquidity, price changes. And that's because in a pre-market, things will tend to trade with less volume and less liquidity. So to get on this list, it has to meet those thresholds, and the stock has to be listed on the major U.S. stock exchange, trading in the pre-market hours. However, if we look at this list, we'll see small cap stocks are in here. There could be ETFs. There could be inverse ETFs, leverage products, closed-end funds, preferreds. So anything that meets those conditions can make this list. And to narrow down to a small group of stocks, we could use the filters here above. If you have a watch list, you can filter by your watch list. So you save the group of stocks and just drop this down and select that group, and the list below will filter by those stocks. We're going to use, in our example, this filter in ETF. When you click on it, you get different ETFs to select from. We're going to choose this one, SPY. That's S&P 500 ETF. Click on that. Oh, I did the wrong one. Let's do SPY over here. And when we click on it, the list below gets filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we have 5 stocks that made our percentage gainers list, 3 on our decliners. So that is more balanced, maybe slightly more bullish, but seems more balanced in a pre-market trading. So I would say that so far the activity, the trading in a pre-market has a slight bullish lean. And well, we did give it a couple minutes already, so I'll take the questions now if you have them.
Yeah, nothing's popped up as of yet.
Okay. All right, so I'm gonna navigate to SPY, which is my default symbol, to look at some tools that we could use, and just examples of what type of insights we could get from these tools. So let's do SPY volatility. On the left-hand side, we have all these menus to select from. And let's take a look at the skew, volatility skew in SPY. And this is looking at the options markets, the implied vols in the options market. And it's trying to measure what does the skew look like in SPY if we compare the implied volatility of higher strikes versus lower strikes. Okay, so this is looking right now at a vertical skew and is trying to somehow benchmark and follow what type of skew are we looking at perhaps in SPY. Is it a flat skew? So a flat skew would indicate that the implied volatility is the same at every strike, right? So if you start at the monies and move up or down, you're going to see the same implied volatility. Let's say it's 12, so it's 12 all the way up or down. But we don't usually see that. We usually see that the implied volatility changes as you move from one strike price to the next. So we could have a skew that slopes up to the downside, slopes up to the upside, slopes up to the downside and down to the upside. So it can move around, right? So the skew could change based on the supply and demand and the trading in the market. Now, to somehow benchmark it, we could use different methodologies. There's no one right method, because one method could try to answer a certain type of question. A different method could answer a different type of questions about the skew. So we're going to start out here with what is this line here showing us, is that if we look at SPY, first we have to define, well, what expiration are we looking at? Because there are expirations that are 0 DT, there are expirations with a week to go, with a month to go, a year to go. and they're all going to be and they're going to be different. All, those expirations will have their own unique structure. So initially we have to decide, well, let's benchmark a certain expiration, right? Certain amount of days to expiration. And in this example, we're looking at 30 days. So 30-day constant maturity. The idea is we're benchmarking if a 30-day option existed every day, how can we track it? And of course it doesn't, because we don't have exactly 30 days every single day. If we look at the options chain, you'll have different expirations, but you don't have like an exact 30-day every day. So because we don't have that, we have to come up with the method of creating a synthetic 30-day. And that's done by using a weighted average of the existing expirations, ones that we could observe, that straddle 30 days. We take a weighted average every day, and we come up with that methodology and formula. And then we look at all the strikes between those and come up with an interpretation or interpolate what that 30-day option skew would look like. Okay, so that's one of the things that we are left with. Those are our choices because we don't have an actual 30-day option expiration to reference. And that's basically how the VIX is also calculated, right? That's just the way we index it. So now that we have the 30-day implied volatilities, how do we compare the skew? Well, in this method, what we're going to do, before we understand what this line is, well, we want to compare how does the skew look like between an upside and a downside, right? Are they equal? Is one higher? Is one lower? So what we do is take the at the money volatility, and we say, let's take that at the money volatility, and let's say it's 12. And we calculate it to be 12. And then what we do is say, let's now pretend that 12, in theory, we're going to run a straight skew through all the strikes. And we're going to pretend that it's a straight skew initially. And by doing that, if we run a straight line, then we could compare the actual versus the straight line to see the differences, right? So if you run 12 and then you say, okay, show me the 25 delta call. Well, the 25 delta call is actually 10. Well, we know it's 2 clicks below, right? The actual is two clicks below that straight skew. And if we find a 25 delta put, and let's say we look at our straight line as 12, but the actual is like 14, well, it's 2 clicks above it. All right. And then we could compare the 25 delta call versus the 25 delta put. So if the 25 delta call and the 25 delta put are exactly the same, there's no skew. It should be 0, right? There's a flat skew. If we subtract the 20, so in here, we're taking the 25 delta put implied volatility, and we're subtracting it minus the 25 delta call implied volatility. So we're looking at how much is the implied volatility in 25 delta put differ from the 25 delta implied volatility call. That's what we want to see. What's the difference between the two? So in this case, we're starting now with the put minus the call. Okay, you could do the reverse, but you have to choose one. So what we're looking at is what is the difference? And keep in mind, if they're equal, then the difference is 0. That means you have a flat skew, right? Then we would be right here. This is 0 right here, this line. But it's not 0, right? And we have the data down here, right? 25 delta put minus call. So if the 25 delta put implied volatility is higher than the 25 delta call IV, then our result will be positive, right? If the implied volatility of the put is lower than the call, well, then this formula will give us a negative number because the call will be higher than the put. All right. And then what we do is we plot it and say, okay, if the 25 delta call, how much is it different? How much does it differ? Right? What is the difference between the put and the call? And then we plot it. And then we take that observation daily. Every day we see, well, how much does it differ between each other today, yesterday, the day before, the day before, the day before? Is it trending? Is it high or is it low? You know, where does it cluster around a certain amount? This is what we want to see over time. Okay, so this is the line right here. This green line is showing us the difference, you know, close to close. At the end of the day, what is the difference? We take a snapshot and then we're doing that for the full year, and then we could see what that difference looks like. Okay, so that's, you could see from last year, February 9th, up to February 9th this year. And we see that when the line spikes up, right? When this line spikes up, well, what does that mean? That means the put relative to the call becomes more expensive, right? The implied volatility in a put relative to the call jumps. When it comes down, as it comes down closer to zero, that means the put and the implied volatility in a put and a call come closer together. They're closer to equaling each other, right? So zero is when they equal each other. When this line goes up, that means the put is more expensive relative to the call. And if it goes below zero, that means the call is more expensive than the put. And in the SPY, we haven't seen it go below zero. It's always above zero because that's just how things trade in SPY, right? People buy protection for the market. They'll use the puts and they'll buy right with the calls. And here we could see where, at what levels in the last year, what were the extreme levels? Or what were these extreme levels? Well, we could see over here a couple of times it popped up, to almost eight vol clicks, over here, 1, 1, 2, 3. It got up here till 6. So now we could just visually see on the graph where those, extreme levels reached, so far. This is keep in mind, this is in the last year. And now we could see how it's trending, right? So it's trending lower. And what this is kind of indicating to me is we know that the stock market has been rallying here in the last like 2-3 months, right? We've had some significant rally, and it looks like that the market itself, along with the rallies, feeling more comfortable, basically discounting those puts more relative to the calls, right? So it's there, we don't see this consistent fear like, well, we might just turn around, really soon. So far, the options markets are kind of feeling more comfortable with the rally, that it's sustainable. There's some, that there's some strength here looking at this just from this perspective, just from this skewed perspective.
AD?
Yeah.
Robert Black's asking, how do we translate this information into examine and trade ideas? What would Dimitri trade given the skew information?
So this isn't a trade. This is looking at the markets and just trying to understand how the markets and options are, reacting, and it's basically insights into the options markets, right? It's trying to say, okay, I'm looking at the options markets, and here's what they look like. This is
in real
this is
time, what's going
this
on.
is what it looks like in real time. This is the options chain, right? And this is what it looks like. It's a bunch of numbers everywhere, right? It's a bunch of numbers, and how do I get insights? What are these numbers tell me? Because the options, the markets themselves, they're it's the markets are trading, they're signaling something, right? These are people's opinions about, forward looking out. They're forward looking outlooks on stuff, right? And this is done through trading and supply and demand. But if we're looking at it, right, if we're just looking at these numbers without any like context or way to translate it into something that, well, what are they signaling? What are they doing? What are they doing out of the ordinary? Then we don't understand the markets. And if you don't understand the markets that you trade in, there's no point trading at all, in my opinion, because it's like, how do you try to trade in a market that you have very little information about what's going on? So this particular chart is trying to explain, a certain, aspect of what is happening in the options, because the skew itself, right? That just exists in the markets. We know that it exists. We know that implied volatility isn't always the same across all strikes, right? That just doesn't happen across the board. So what we're trying to do is determine, well, how does that skew look like right now relative to history? Okay. So this isn't a trade setup. It's more of looking insights into the market. What's happening in the markets?
Thanks.
Yep. So let's come back to the skew. And when I say that, I'll give you guys an example, right? If you're in a real estate market, right, before you can make any investment, you start to study different factors that impact your potential, your decision in making those important investments, trades. So, for example, you might first look at, well, what do the taxes look like? What do the local taxes look like? That's important. I know prices, but are the taxes going up? Are they going down? Do I think that what are they relative to other counties? How are the budgets look in this county? Or am I in a potential situation where taxes are low and could go higher? That's one aspect. Another is you could look at the mortgage rates, and say, well, where are the mortgage rates versus last week or the week before, and what are the rates in the 30-year fixed versus the 15-year fixed, and so these are different aspects of the market that you should. What are the insurance? What are the insurance rates here? Some places, I know, closer to water, the insurance is higher than other places that are further away. So knowing your markets, knowing different aspects that impact, the markets is important. Because otherwise, any trade setup without knowing that, you're just exposing yourself to you're being misinformed or less informed, let's say, than you should be. Does that make sense? Why we're
Yeah, that was helpful.
okay. Yeah, so getting back to this chart. So we see two more lines, right? We see now this red line right? Which that's the 52. I'm sorry. So this is the last 20-day average, this red line, just to see where we are most recently. And this yellow line is the 252-day average. So we could see that the last 20 days, the red line's below the 252. So we've been, trending lower basically. And you could see that where we are here today versus the 20-day moving average and the 252-day. So we're on the low end of that skew. Okay, so if we just looked at this year's of data from one extreme level to the other, we're probably on the lower end of the extreme than on the higher end. Okay, looking at that 1 year's of data set. Now we have other tabs here. I think maybe we'll go over tomorrow if you guys have questions about it, but we'll go over these, the following days. Oh, and a reminder, tomorrow we have a webinar with Interactive Brokers at 2:00. You have to register with Interactive Brokers. It's not going to be live like we do this one on YouTube. Interactive Brokers is hosting it. Well, if you could put that link in.
Yeah, that's Lincoln trade data for valuable insights, correct?
Yeah, and we're going to talk about exactly looking at data sets and how do we combine the data sets, kind of like here, to get more meaningful insights, because a lot of financial data is scattered, right? But it's scattered, it's raw, it needs cleaning, but how do we take that data and connect it to get meaningful insights into the markets?
All right, well, we're right up against the opening. Rob did have a couple more questions. I will copy those and give them. Maybe we can talk more about skew tomorrow.
Okay.
He has questions around it. I put the link to the webinar tomorrow in the chat. So anyone who hasn't registered, you got to click on there to register. Awesome job, D.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.